Welcome back, my friends. As you all know, many YouTubers are talking about real estate. Some are predicting a collapse. Others are cheerleading for a new surge in real estate prices. But most of these people are talking about residential real estate. Almost nobody is discussing commercial real estate. This despite the fact that we are hearing headlines about vacant office space. WeWork released an embarrassing statement recently about the New York Stock Exchange threatening to delist its stock. Beyond SoftBank, several VCs still had large stakes, including Benchmark and Insight Partners. So, what does this mean for commercial real estate? What does this mean for the real estate industry? What does this mean for the future of the economy? And, what does it mean for the future of the United States? But, before we get into that, please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. And, before we continue, a word from the sponsor of this video. Today's sponsor is InnerLife.com, creator of the InnerLife STS system. InnerLife STS is a cloud mobile platform for mental health care and its integration with primary medical care. InnerLife STS is designed for assessment, data collection and analytics, documentation, and progress tracking. InnerLife STS creates and composes conceptualized narratives and builds them into professional-grade reports. These reports are designed for use by mental health professionals, primary care physicians, justice system professionals and universities, and include mental health assessment reports, mental health treatment reports, and treatment progress reports. And InnerLife STS uses doctor-selected pseudonames for all patients. So, only the healthcare professional knows the patient identity. WeWork is a company that provides flexible shared workspaces for freelancers, startups, and small businesses. The company was founded in 2010 and has since grown to become one of the largest providers of co-working spaces in the world, with locations in over 100 cities across 27 countries. WeWork offers a range of workspaces, from private offices to open co-working spaces, as well as amenities such as high-speed internet, printing and scanning facilities, and conference rooms. The company's spaces are designed to foster collaboration and networking among its members. In addition to providing workspaces, WeWork has also expanded into other areas, such as residential co-living spaces, under the brand name WeLive, and education and training programs, under the brand name WeGrow. WeWork has faced some controversies over the years, including concerns over its business model and financial sustainability, as well as issues with its founder and former CEO, Adam Neumann. WeWork's disastrous demise can be attributed to a number of factors, including its rapid expansion, questionable business practices, and leadership issues. One of the primary causes of WeWork's downfall was its rapid expansion. The company grew at an unprecedented pace, opening new locations at an exponential rate and taking on massive amounts of debt to finance its growth. However, this rapid expansion proved unsustainable, and the company began to struggle to fill its spaces, leading to mounting financial losses. Another factor that contributed to WeWork's downfall was its questionable business practices. The company's business model was based on long-term leases for properties, which it then sublet to members on a short-term basis. This created a significant imbalance in the company's financials, with WeWork being on the hook for long-term lease payments even as its short-term revenues fluctuated. In addition, the company's management practices came under scrutiny, with reports of a toxic culture and excessive spending on luxuries such as private jets and lavish parties. Finally, WeWork's leadership issues also played a role in its demise. Founder and former CEO Adam Neumann was criticized for his eccentric behavior and his disregard for corporate governance. Neumann's management style was described as impulsive and erratic, and he reportedly made decisions that were not in the best interests of the company. All of these factors combined to create a perfect storm that ultimately led to WeWork's downfall. The company's rapid expansion, questionable business practices, and leadership issues all contributed to its eventual collapse, and serve as a cautionary tale for other startups looking to grow too quickly. WeWork has frittered away $46.7 billion in value as the stock sinks below 50 cents, one of the biggest startup failures of all time, and venture capitalists haven't learned a thing. Last week, WeWork was forced to issue an embarrassing press release warning that it was in danger of being delisted from the New York Stock Exchange because the stock has traded below $1 for so long. In 2019, prior to a disastrous attempt to go public that resulted in the exodus of its flamboyant, controversial founder, Adam Neumann, WeWork was valued at $47 billion. As of Monday, with shares trading at 47 cents and a market cap of $345.7 million, the company has lost some $46.7 billion in value over 4 years, vanishing like a sand sculpture left in the wind. In 2021, the company briefly looked like its fortunes could turn around. It was acquired by BowX, a blank check special purpose acquisition company from Vivek Ranadive, the founder of the software company Tibco, who is perhaps better known as a former owner of the Golden State Warriors and, more recently, the Sacramento Kings. WeWork's valuation at that time was $9 billion. But WeWork crawled into 2023 so loaded with debt that it has yet to find its footing or future. Last month, it struck deals to restructure debt, cutting obligations by about $1.5 billion, and extending the due dates of other notes in an attempt to preserve cash. When a $47 billion startup shrivels so drastically, who gets hurt? The investors. In this case, SoftBank has suffered the most by far. Its Vision Fund is still the largest shareholder of WeWork with over 461.5 million shares, or about 62% of the company. SoftBank has been in a world of hurt over WeWork, and other missteps, for years now. Other venture capitalists are still holding the bag, too, with significant stakes in WeWork including Benchmark, which still holds over 20 million shares, or nearly 3% of the company, and Insight Partners, which holds almost 13 million shares, or just under 2%, according to recent regulatory filings. Then there's Newman, who owns over 68 million shares of common stock and virtually all its Class C stock, nearly 20 million shares. While WeWork puts a bit of egg on the faces of Benchmark and Insight, it is ultimately only a speck amid what is otherwise, year after year, enviable performances. For instance, Benchmark had a big stake in Amazon's $3.9 billion purchase of One Medical, one of the few splashy acquisitions of last year. And Insight is known for its investment in winners like Databricks and SentinelOne. While Newman's WeWork holdings are in sad shape now, he has already been redeemed Silicon Valley style. He's back with a new startup that raised $350 million from the VC giant Andreessen Horowitz in August 2022, its biggest check ever, and is back on the tech speaker circuit. A WeWork spokesperson declined to comment but pointed to its last earnings for Q4 2022, when it announced an 18% year-over-year increase in revenue for the quarter. Staggering as it might seem to blow away nearly $47 billion, with those kinds of repercussions, WeWork isn't a warning for most of the venture capital community. Mortgage defaults have hit downtown Los Angeles as demand for office space continues to decline. High office vacancy and interest rate hikes have contributed to a string of defaults this year and fueled concerns of a commercial. Brookfield DTLA is located in the heart of downtown Los Angeles and is part of a broader revitalization effort of the area. The project has played a significant role in transforming the city's skyline and has become a notable landmark in the city's downtown core. Defaulting on an office tower means that the owner or borrower of the property has failed to make payments or meet other obligations related to the financing of the property. This can include missed mortgage payments, failure to pay property taxes or insurance, or breaches of other contractual obligations with lenders or investors. When a property owner or borrower defaults on an office tower, it can trigger a series of legal and financial consequences. For example, the lender or investor may initiate foreclosure proceedings, in which the property is seized and sold in order to repay the outstanding debt. In some cases, defaulting on an office tower can also have broader implications for the real estate market and the wider economy. It is therefore important for property owners and borrowers to manage their finances and obligations carefully to avoid defaulting on their properties. Brookfield Properties is a subsidiary of Brookfield Asset Management, a global alternative asset management company. Brookfield Asset Management owns and manages a diverse portfolio of real estate, infrastructure, renewable power, and private equity assets around the world. The company was founded in 1899 and is headquartered in Toronto, Canada. Today, Brookfield Asset Management has over $600 billion in assets under management and operates in more than 30 countries, with a focus on investing in high-quality assets that generate long-term value for its investors. It's a major sign of struggle when huge office landlords are defaulting on their loans. Brookfield is the largest office landlord in downtown Los Angeles. And now Brookfield is suffering blows from dissolving demand and rising interest rates. The corporation defaulted on loans tied to 2 office skyscrapers in the city. But what a difference a year makes. The real estate market in the United States has reversed course. And investor sentiment is turning bearish, to say the least. Blackstone has taken heat over the past week for limiting withdrawals from the $69 billion private right. As you might imagine, in a degrading real estate market, publicly traded REITs have gotten slammed this year. If you follow this channel, you already know that the Federal Reserve is aggressively raising interest rates. And the rising interest rate environment is sending real estate values into decline. The real estate market has been hit hard, especially commercial real estate. Practically everyone is raising questions about the actual values of real estate. That is especially true of the real estate holdings in private funds such as Blackstone's BREIT. Just as a comparison, the $35 billion Vanguard Real Estate ETF has plummeted 26% year to date. But, what do you think? Please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.